Welcome to the Jay Martin Show. If you are new to this channel, my name is Jay. I'm an investor looking for the smartest home for my cash, maybe just like you. If it is, then you're probably going to like what we do here. Now, my guest today is David Hunter. He's the Chief Market Strategist at Contrarian Macro Advisors. And today we get into his near-term, medium-term, and long-term forecast. Near-term being the balance of 2023, long-term being his outlook all the way to the mid-2030s. Now, near term, quite a controversial outlook. He's calling for an aggressive market melt up. He's calling for the S&P to go up by 70%, for an example. Now, a lot of investors might call that crazy, especially if you believe that the market is already incredibly overvalued. And I tend to agree with that statement, but his rationale is quite sound. The number one reason that investors buy stock, he argues, is because other investors are buying stock. And if you look at the S&P over just the last 6 months, it looks relatively healthy. And that is enough for investors to feel FOMO and start chasing rising share prices. Doesn't mean I agree that it's a good decision, but it's often what drives market cycles. So could that continue for the balance of this year? I don't see why not. I'm excited. I'm looking forward to finding out if he's right or not. After that, he is calling for quite a dire deflationary bust, leading to the most aggressive commodity cycle we've ever seen in my lifetime, from about 2025 to 2030, at which point everything is going to fall apart. So, very aligned with a lot of the guests that I have on my show in that, our global debt bubble will eventually burst, leading to some kind of a coordinated global recession or depression. He's just saying we can kick this can down the road a lot further than anybody thinks, which is quite aligned with what's happened thus far, isn't it? I mean, this has been the conversation for the last 20 years. So anyways, I enjoyed this conversation. I learned a lot. I tend to agree with his thesis that investor psychology is often what drives short-term share prices. I actually write an essay every Sunday on investor psychology. So even though I manage a portfolio of equities, what I write about in my Sunday essay isn't managing money, it's managing my mind and studying behavioral economics, what I believe really drives market cycles. If you want to subscribe to my weekly newsletter, I publish every Sunday. It's free, and there's a link right beneath this piece of content where you can do so. And we dive into the nuances of investor psychology, heuristics, biases, our blind spots, what traps us as investors. I think the most important tools in every investor's tool belt. That's what I believe. Anyways, here is David Hunter. Enjoy.
This is Jay Martin.
All right, here I am with David Hunter. David, it's a pleasure to have you on the show. Thanks so much for making the time.
Yeah, hi, Jay. Great to meet you, and thanks for having me.
I'm looking forward to this. There's a handful of different directions that I want to go. Let's start with this. Today, for context, is June 14th. So we just had the Fed meeting. Initial thoughts, David, at this point, spun out of what you saw and heard at today's Fed meeting.
Sure. Obviously, the pause or the skip, as they call it, wasn't surprising. It pretty much was telegraphed and was what expectations were. I think the street was a little surprised by, maybe quite surprised by the hawkishness. They expected some hawkish commentary, but the hawkishness with which the FOMC announced at least 2 more rate hikes and, talked about the need to remain very much aggressive on the tight side. So I think that was as much, and I've been saying this for quite a while, I think that was as much to guard against the market running away and getting excited about a pause. They wanted to keep the message balanced so that people were at least still concerned that there's further rate hikes to go. I think they're sincere in believing they may have to hike a couple more times, but I think they bent over backwards to send that message and make sure that people aren't focused on the pause, that they're more focused on the fact that there's more tightening to come. I think that speech of Bill Dudley's back in April 2022 still is resonating in Powell's ears. I mean, he's still very much believing that the market, as much as they're focused on the economy, I think they're also focused on the market from the perspective of not wanting to run away on the upside. So he doesn't talk about it anymore. It used to be very transparent that he'd send out his his fellow governors to talk the market down after meetings because it started to run away. I think he learned his lesson that he wasn't in control of the market, so he's less likely to do that. But I think today's sort of the same thing of trying to jawbone the market down a little bit by, staying hawkish.
Yeah, that's interesting. And it seems like in that sense, this could have been a very sincere meeting, right? The pause or the skip, as you put it. But, by estimating there'll be another couple of rate hikes in the future, it gives them the optionality to pull the trigger and stay true to the game plan. But if they don't, it's also easily forgotten, right? Now, you stated, I think, probably a couple more years. I think you said a few years before anybody could expect a rate cut. Do you also think that is fairly a realistic timeline?
Not at all. I think that's kind of nonsensical, but that's how Federal Reserves, how the Fed works. It's basically they're all academics, and they look at long-term projections and dot plots and all of that. Realistically, the way markets work, things get discounted a lot faster, and you see a lot more volatility in rates both up and down. So I don't know whether we're going to see rate cuts before the end of the year. I think we might be, not because they think so, but because the economy could decelerate a lot faster than they expect. They're used to kind of drawing, putting everybody's numbers together and drawing a consensus out of that. That's not realistic forecasting. I mean, it's going to be the outlier typically that happens. So there's a lot of information out there pointing to an economy that's going to decelerate in the second half. Yeah. And they are not anywhere near recognizing, I think, how fast it can decelerate. You've got, leading indicators certainly pointing sharply down. You've got, money supply obviously has contracted. You've got, the very rapid rise in rates and what it's done to the financial system and credit conditions. And you look at a 7% mortgage rate, and that's going to have an impact on the housing demand. So even though we've had a spring-summer bounce in housing, I don't think that's going to be sustained. So, I think as we move through to the end of the summer and into the fall, you could begin to see the economy decelerate faster than they expect. So, as I say, I don't put a lot of credence or confidence in Fed forecasting. They've not got a great track record of it. I think they're trying. I don't question their abilities as economists, as academic economists. Powell's obviously not an economist, but again, history of the Fed says this is not where you want to go to kind of project the future. They're typically going to give you a consensus forecast that's not going to prove correct.
Now you've spoken on Twitter and in a few interviews about your forecast for a market melt up through the balance of this year. Relatively aggressive, right? S&P maybe to 6,000, 7,000 points. Can you walk me through that thesis, David, and exactly what you're expecting could occur?
Sure. Yeah. Thanks for being polite, because it's a lot more than relatively aggressive. it's a lot of people would call it crazy. But it's basically saying, we got last year, you had so many people line up on one side of the boat. Everybody got bearish, starting after Russia invaded Ukraine. And from there on, with inflation, blowing up and the Fed getting aggressive, it was pretty easy to see that everybody had moved to the bearish side and was projecting pretty dire things. 3,200 became a consensus, and there were a lot of people looking for a lot lower than that. So I'm a contrarian, and I've been involved in behavioral investing for 50 years, and it was pretty obvious to me that it wasn't going to work out the way everybody expected. And my thesis was that as you got to a point at 3,500 in October, and very extreme bearish sentiment. People were just assuming it was going to 3,000 in a hurry, and I was bullish and said, I think this is the bottom. And as the tape moved up, you could see people were remaining on the bearish side. The sentiment was remarkably staying to the bearish side. And it's only obviously since we've broken above 4,200 that you're beginning to get some of that positioning nervous, and you're beginning to see it gradually shift. Okay. And investors, both retail and professional, typically are driven by the tape. They may not know so or say so, but as the tape moves up, you'll see more bullishness come in. You'll see, and for the institutional investor, the pressure gets immense as they continue to miss the move. Their returns fall behind. They can't hide in a 5% money market. They can't be satisfied with lagging the market when the market's starting to really move away from them. So the pressure becomes kind of the thing that pushes the market even further, feeds on itself. Some of it's FOMO, some of it's short covering, but and my belief is that we're very early on in that process. And what will help it fundamentally is this whole thing of, as the economy slows, interest rates are going to come down, the dollar is going to come down sharply, and the investor is going to begin looking over the trough. If they can be convinced, they won't be convinced by today's rhetoric, but if they can be convinced that the economy is decelerating more rapidly and that the Fed's tightening is over, that's a signal for them to look over the trough, to look past the slowdown, whether it be a recession or what have you, and start projecting higher numbers in 2024. So everybody, as you know, there's one guy in particular who was very focused on today's earnings or this year's earnings and saying the market has not yet discounted the bad news that's coming. I think that's discounted. And I think what's not discounted is a change in expectations to higher numbers next year. As that starts happening, as the earnings estimates get raised for 2024, it gives more room for the market to move up. So what seems insane in terms of talking about an S&P 6,000 or 7,000 at S&P 4,000 when things look dire, or certainly look like we're going the other direction in the economy, all of a sudden, when you're up at 5,000, you can start rationalizing 6,000 because you're raising earnings estimates for next year.
So that makes logical sense in my mind. Buying feeds on buying. Investors that were bearish see the market start to run, feel like they're missing the trade. People chase share prices. They always do, right? And so exactly. We're anticipating more of that for the balance of 2023. Your thesis also comes with a deflationary bust at the end of it. And so I'd love you to walk me through, if you can speculate on what those catalysts might be to turn that market sentiment. I mean, everything lines up in terms of the bull, like a rally running here in the market in terms of FOMO, people chasing share prices, a pause in rate hikes. Like, it doesn't take much for people to become optimistic and start buying in again. And we're witnessing that. It's occurring. Look at the S&P chart. Yes, it's looking very bullish. But where are the fractures? Where are the vulnerable points? And is it just economic data, or what leading indicators would you look for to think like we're getting towards the top of this and this market's about to turn?
Yeah, because I've had this, by the way, I've had this view of we're going to have a melt up first and then a bust following the melt up.
Yeah.
For quite some time, and basically 2020 and 21, I was saying that too. And we did have a melt up, but this, what happened in 2022 extended it. So along the way, what's funny, this is psychology, is back in 2021, towards the end of 2021, I said the market's, running up against a place where it needs to correct. And so I anticipated a correction in 2022. I didn't expect the kind of bear market we got, but I was anticipating 10% or more. And but at that time, what I was hearing from everybody was melt up makes sense. I can't see where you're going to get the bust. Of course, market had just run 100%, so they were bullish. Fast forward 6 months, and the 6 months following that, and all I heard up until very recently, all I heard was the bust. I believe your bust. I get your bust. I don't get your melt up. Your melt up, you're going to be wrong on your melt up. So again, psychology, because we were, people were very negative and they could understand the rationale for a bust. So now we're beginning to push where more and more people are coming to the bull side again. It's gradual, but starting, like you said, and so now it's melt up is becoming at least believable, and people are starting to say, yeah, but where's that bust going to come from? And I'll say my answer to that is my whole thesis is that a bust is I define a bust as more severe than a recession, but at the speed of recession. So it's basically, it'll feel like a depression, but it'll happen in the context of maybe a year, 12 to 15 months. Not like the Great Depression that runs for a decade. So it's something, and I think it's accompanied by a financial crisis of historical proportions. So my whole reason for calling for a bust rather than a recession, normal recession, is the leverage in the system. We've got 300 trillion in global debt, and that's up from 250 trillion just a couple of years ago. So it's moving up very rapidly, and quadrillions in notional value derivatives, which is leverage on markets. So we are at a place where we've never been before. Leverage is something that works great on the way up, helps enhance returns on the way up. It decimates you on the way down. So a normal downturn, when coupled with this kind of leverage, turns into something bigger. And I think bust basically something we almost saw in 2008-9, but they pulled us back from the cliff just in time. This time, I don't think they are going to be able to pull us back from the cliff before it happens. So I think bust means major bank failures around the world. Less so here because of the medicine we took in 2008-9. Our banks are less leveraged by far than they were then. Europe's very vulnerable. You guys up in Canada are very vulnerable. The banks up there were very clean going into 2008. They didn't learn our lesson. They are now us.
Yeah.
So and Australia is very leveraged to their real estate, and I think they're in trouble. So, and of course, Asia is a wild card. China is a wild card. So I think you just have far beyond any leverage we've ever seen before. 2008-9, I mean, it was just the last cycle. We're way beyond that degree of leverage. So it's been a dozen years here of just levering up like crazy. So that's where the bust comes from. It's helped along by what I think is a very big policy error, what I call potentially the biggest policy error in history. I think the Fed is making an egregious mistake. I think they've overstayed the tightening already by a lot, and they're talking about tightening further. They are guilty of wanting to see the results before they change their policy, right? They want to see 2% inflation before they change, or something close to that. This stuff, the way I've tracked, I came into this business in 73, so I've tracked 6 cycles. What I've seen in every cycle is stuff happens gradually until it doesn't. And then all of a sudden, the crack happens very fast. I mean, we saw a little sliver of it with Silicon Valley Bank and the events around the regional banks, how fast things can change. It was basically a weekend. And that's what I think we're going to see on a much larger scale globally at some point. And I don't know whether it happens this fall, this winter, early next year, but it's in that window. I think it's sometime between beginning of fourth quarter and end of first quarter. That's kind of when I think the bust really gets going. And so that's, and as I've said, the melt up when we're at 6 or 7,000. I'm going to be the extreme contrarian I was in the other direction, saying, this thing is a house of cards, get out. And I guarantee you, most investors are going to be all in, telling you why this thing has legs, why it's the beginning of a cycle. It just started, so this isn't the normal cycle. I mean, this is what I keep saying, is this is the end of a 41-year secular bull market that started in August of 1982. That's when disinflation began. It's going to culminate in this blow off top, and then the biggest bear market and downturn we've had since the Great Depression.
I publish a weekly newsletter every Sunday. If you would like to subscribe, hit the link right beneath this video. Now, I'm an investor, but I don't write about managing money. I write about managing my mind. Without question, the hardest and most important part of allocating capital through volatility and getting some back. If you want to read my newsletter, hit the link right beneath this video. I know you'll love it. Now back to the interview. Enjoy. I completely agree with you. If the S&P right now is, 4,300, if this runs to 5,500, 6,000, 6,500, of course. I mean, when you make a bet on something and the price goes up, most people just are the recipient of higher conviction that their idea was even better than they thought it was, right? And so they double down on that same bet. I'm smarter than I thought. I'm more correct than I thought. Look, affirmation in the price of whatever it is I'm trading. And so if you're curious bullishness at 4,300, you're aggressively bullish at 6,300 without question. I mean, we've seen that sentiment. That's human behavior. Your comments about the Fed executing the biggest error in policy history on the back of waiting for results to change policy. So what you're saying is that they're essentially waiting on real-time data to adjust their policy, when in reality, their policy doesn't hit the market for 6, 9, 12 months at times, right?
Precisely. Yes.
There's a large lag there. And that'll force them, well, if you follow that game plan, inevitably you end up going too far down the path, further than you intended. What do you think is going to break first? Like, what strikes you as what happens when you go too far down the path, as maybe they've already done?
And by the way, I should add too, that the other thing that's in here that's different is we had the pandemic, and we had a shutdown of the entire world economy for a quarter, and then pumped in so much liquidity, so much monetary and fiscal stimulus, unprecedented. So what we have is a very confusing cycle. That's why it's taken so long to slow, even though I think they tightened too much months ago, because there was that excess savings that was pumped in from the government, and there's been this shortage of workers because the pandemic kind of pushed a lot of the baby boomers into retirement, and also sidelined a lot of the kind of the lower end workers, teenagers, etc., because of the pandemic. Their parents said you don't have to work or whatever. So I think that all has extended the cycle or confused the indicators, and makes it even harder for the Fed to kind of get their hands around what's going. So I forget what your question was.
Well, I guess I was curious, what you thought might be next to break. I mean, that was Powell's statement not too long ago. We're going to keep going until something breaks.
Yep.
We broke a few banks.
Yeah, he broke a few banks. In normal times, I think a Federal Reserve, our previous Fed regimes, would have seen that as the signal that we have to ease. But again, because this one is for a couple of reasons. Number one, they missed the inflation run up, so they're feeling like they don't want to be too early and going the other way. They don't want to make two mistakes, so they're almost making a double mistake because they're still thinking about the error they made the first time and now overstaying the tight side. And I think Powell's also, even though he's been on the Fed for many years, he's an attorney, and I think he's a very capable guy, very smart guy, but he's not a market guy. And so, I'll go back to the Bill Dudley speech. I think it's the most reckless thing and the stupidest thing that ever came out of the Fed is to say that you should target the stock market, that the Fed knows best where the stock market should go. When they decided that, the market has, his whole thesis, as you know, was that to tighten credit conditions, to tighten financial conditions, we need a much lower market because of the wealth effect, et cetera. So in essence, he's telling Jay Powell, you need to target the market lower. You need to drive the market lower. And for many months, you could see it. As I said, last fall, every time the market picked up its head, out came 5 or 6 Fed governors to talk the market down. And he was clearly targeting 3,000. And then he kind of learned his lesson. He had his head handed to him because the market kept going against him and moving up through the end of the year and into the early January. So he stopped doing that. But I don't think he's abandoned that thought process that, the market going up is a bad thing. We have to, and also he's very aware of the Fed put and the criticism that the Fed got for having a Fed put. And he's trying to reverse that and make sure the markets know there's no Fed put. The Fed's not coming to the rescue. So all of those things are kind of in his head. And I think that means when it's time to ease, which it probably was time to ease when Silicon Valley went under, and when it will be time when the economy decelerates even more, he's not going to be ready to do it because of all these things in his head telling him we gotta be careful. We don't want to reignite inflation. We don't want to cause the markets to go up because they believe we got their back. So all those things are, I think, going to be part of the thing that causes the error, is that those things are all kind of hanging around him and saying, I got to err on the side of tight, when in fact you're on the edge of, meaning months away from perhaps the biggest economic decline and biggest financial crisis in the post-World War II era. So I think it's an interesting time. And again, it's not that I think he's stupid or that he's not trying to consider both sides of things, but you got those things out there that I think kind of make it a perfect storm.
Okay, so let's say this thesis plays out 100% correct. I would then ask myself, how do I play this as an investor? And maybe the obvious answer is, well, buy the market, right? Ride this melt up. I am not going to do that because I just feel like if I don't have a competitive advantage, I don't like to play the game. Like that's just, frankly speaking, I'm just being honest. I don't have one when it comes to buying the S&P, so I'm not going to do that. Plus, even if this melt up lasts for 9 months, it's just too short of a time horizon for me to have confidence in my ability to time that. That's too short for my liking. So I'm looking at very undervalued, and I like equities. I do buy equities. I buy a lot of commodity equities right now. We can talk about, what I'm looking at. Love to get your thoughts on this, but I like things that nobody likes. That's the contrarian in me, which is a hard muscle to flex, isn't it? By the way, to run into the burning building, like it's easy to say you're a contrarian, to actually do it is a whole different story. But for those of us who don't want to chase the market up, right? Where do you look for safe haven status right now? Do you see anything that's egregiously undervalued right now, David? What strikes you as a good buying opportunity?
Yeah, I'll tell you, I have to walk a very fine line as a macro strategist. I can't, I'm not licensed as an advisor, so I can't give advice and I can't make recommendations. But I can say this. I think, and first I'll say, in answer to your response, you're right. I think, and I say this on Twitter all the time, it's a conundrum here, because if I'm right, we're about to see a 40 to 60% rally from here in perhaps less than 6 months' time. Almost unheard of, almost unprecedented. At 40 to 60% in the S&P and more in the Russell and in the NASDAQ, and certainly in other areas, other sectors, those kind of returns are typically, 2-3 plus years worth of returns. And just because they happen in 6 months, I caution people, know yourself, because everybody has to kind of judge for themselves how nimble are they, how comfortable are they with risk, etc., and how well are they going to be able to discipline themselves on the other side. So there's no one size fits all. Everybody has to make that decision. But so in short, it's a huge reward, but as you're saying, it's a huge risk because it's so short term. And of course, I could be wrong. But that being said, the area, one area where I think there's reward, but also relatively low risk, is in long duration treasuries. You're at, if my thesis plays out, we're at peak inflation, or we're at peak inflation 6 months ago, 8 months ago. Inflation's coming down. Long rates peaked back in September, October, and although they're backing up here, and I think you could fill in a gap at 390 on the 10-year. You've already filled a gap at 4% on the 30-year. I think your upside in rates is very limited, and your downside, I'm calling for 250 on the 10-year this summer, and then 0 or below on the 10-year in the bust. So if rates have peaked or are very close to a secondary peak here, I would argue that you can almost have your cake and eat it too there, because unless you get a breakout in inflation, you can take the lower risk of a government guaranteed bond, lower credit risk, and get the interest rate benefit of a declining period here over the next 6 to 9 months, or actually probably 6 to 12 months or longer. TLT, for example, selling down in the low 100s, 102 or 3, wherever it is, I think can get to 200 in the bust. Won't be a straight line. You'll have some backups along the way, but to be able to say you could almost double your money in a government guaranteed long duration treasury vehicle is very unusual, number one, and allows people who want to sleep at night to at least have something where I think the downside risk is not great. Because if the economy comes fast, if the economic decline and financial crisis comes faster, you're going to see the treasuries get bid up. The real risk in treasuries is if inflation breaks back out here, then you could have rates rise farther and maybe exceed their peaks. I think that's a low probability event, but that's my view. In terms of equities and things, it's people have to understand you can make an awful lot in a hurry if I'm right about my equity forecast, but I'm also calling for an 80% bear market. 80% bear market within this next 12 months.
That's heavy. Okay, so play with caution on that front. What are your thoughts on alternative asset classes? Let's go into gold and Bitcoin. Bitcoin, which is largely tracked the S&P to a greater or lesser extent, more than I thought it would. But what are your thoughts, gold and Bitcoin, David?
Yeah, I beg off all crypto, Bitcoin in particular, or not in particular, but Bitcoin's probably the one that everybody should look at if they're going to look at crypto. And I beg off it and just say I don't follow it. I want to see it get through the bust. Haven't been through a full cycle yet. I want to see what happens. So I just don't follow it. I have my opinions on it. I am skeptical of it, but my views aren't worth a lot because I don't follow it. I've appeared on a couple of crypto sites. Natalie Brunell's. I was with her before she took off with crypto. So she interviewed me a couple of years ago. So and more recently another one. So crypto guys do follow me, but I really don't offer any opinions on crypto. I'm a huge bull on gold and silver, both here and longer term. I believe gold can get to 310. This has been a long held forecast for me in certainly last year or two. I think gold can get to 3,000 pre-bust. I think silver can get to 60 pre-bust, which means this year probably. And then I think they get hit pretty hard in the bust, along with most assets, and certainly commodities. And then post-bust, I think by the end of the decade, because of the amount of money that's going to have to be pumped in to save the system globally, I'm forecasting the Fed's balance sheet will grow to 30 trillion in the bust. So in the next 2 years, because and proportionally similar around the world in every central bank, because the system's basically imploding. Because of that kind of money, we're going to have a commodity cycle unlike any in history. So I'm predicting $500 oil. I'm predicting $20,000 gold. I'm predicting $500 silver by the end of the decade. So, there's a nice run this year, but the true run is post-bust, which is basically 2025 to 2030.
And so you mentioned gold, oil, and silver in that post-bust run. Would you also lump in other hard commodities? If you're bullish on oil, would you be bullish on copper and nickel and a variety
Absolutely.
of basket of base metals?
Copper and the base metals will all run and be far beyond any levels we've ever seen before. Many-fold from current levels. I think ag commodities will play big time. I think natural gas obviously will run with oil. I talk about an 80% bear market in equities, and then I also say that we will not see the highs reached in this final blow off again for decades. So this is an all-time peak in equities for at least the next 2 decades. And people get very discouraged because I'm also calling for a collapse in the 2030s, global collapse, economically, financially, basically the end of a 90-year Ponzi scheme. So people get very concerned about what do I do, and I go, you have one last huge opportunity, 2025 to 2030 in commodities. It will be a cycle every bit as exciting as the last 40 years in equities, except it'll happen in a very short time. It'll be through the roof.
So if I were to walk through this a little bit, market melts up through the balance of 2023. At some point, deflationary bust, 80% correction thereabouts in the market, putting us in pretty dire territory, broad equities from a broad equity standpoint through 2024. A lot of economic pain, probably a lot of jobs losses, probably a crashed housing market. That will inspire record stimulus globally, fueling a commodities run from 2025 through the balance of this decade. All of that I can visualize. What is leading to your mid-2030s global economic bust, and how will that be different from what you see occurring through 2024?
Yeah, the biggest difference is the fact that the bust, because we're on the verge of deflation, even though everybody's worried about inflation, the bust will be deflationary. In deflation, the central banks have unlimited ability to print, right? In inflation, if they print, they're just putting more gasoline on the fire. So in deflation, so even though they're going to talk now about inflation and not wanting to ever go back to what we did the last couple decades, printing money like crazy and propping up everything. When you're faced as a policymaker, and both our government bureaucrats and our Fed policymakers, when you're faced with an economy, and this is true of all the governments around the world, with an economy that's imploding and major banks around the world just dominoing into failure. You don't sit by and say, well, I can't print money because that might be inflationary. You do whatever you can to save the system, right? And so they'll print money like there's no tomorrow. You know, we saw 5 trillion come out of the Fed in 2020, right? This will be, you know, probably 4 times that, 4 or 5 times that. And it's because, you know, it's basically seeing the whole system before your eyes starting to fail. You know, look how nervous people got with Silicon Valley Bank, which was, you know, just a one regional bank, and how that was starting to domino through regionals. This will be, I think Europe's the most vulnerable. Their banks are a mess. But also, you know, our banks will be hit. There's a lot of counterparty risk. There's all kinds of things out there. And you're going to see businesses, you know, there's going to be you know, a forced deleveraging, you know, a lot of involuntary debt liquidation throughout the world. And so the only policy tool they have that works with any speed is money. I mean, you know, they can declare moratoriums and things like that on debt, but you know, the only thing they really have where they can respond with the speed, you know, when markets implode, they move by the minute, right? They move quickly. You can't wait for Congress to sit down and deliberate. What are we going to do? I mean, they were pretty damn quick in March of 2020, but it still took a couple weeks, and then it's piecemeal. It's okay, we'll do this, and then, you know, they're back to the drawing board. Okay, we'll add another tranche, you know, and so the thing that can be pushed out in a hurry to save a system is money, and that's what you will see. And money, of course, works with a lag. It does some things in terms of liquidity immediately, but in terms of turning economies and things, it works with a lag. So they'll put in trillions and still be seeing things deteriorating, and have to put in more trillions and see things deteriorate, because it takes 6 to 9 months for things to start turning around. So, yeah, so the financial can be stabilized, but the economy won't be immediately. So that's the difference between now or next year and what I see in the 2030s. In the 2030s, so with that kind of money, what you're going to get is a commodity-driven, inflation-driven recovery with a lag. You know, so it probably starts in 2025 sometime and accelerates as you move through the decade. And what it means is you're going to go back to inflation at levels we saw in the early 80s, and I was there, and probably exceed that. So my guess is we're going to see 25% inflation year over year. And if you get that, what are you going to have for just government rates? I mean, you know, in 1981 we got to 15% on the long bond and the 10-year. In this next cycle, I would expect it to be higher than that, so somewhere between 15 and 20%. When you've got debt at the levels we're at now, and then you add to that, because the money, you know, let's say we do 20 trillion expansion in the balance sheet, that's going to be accompanied by 20 trillion in new treasuries and 20 trillion in new fiscal stimulus that they're going to monetize it. So you're going to have debt even far higher than it is today. Try to solve that equation. How do you fund debt with 15% and higher service costs? And T-bills, of course, will be 20, 25%. So it can't happen. I mean, initially, early in the cycle, because you're coming out of deflation, so rates are going to be down near zero, it'll take a year or two to get them up to high single digits towards double, and then they ramp up from there. So the first couple of years, they're going to try to solve that equation with more debt. You know, let's float more debt to service our debt. That ends very quickly, because you're pouring fuel on the fire, and you're going to end up, you know, you just can't keep up with it. You know, so by the end of the decade, I think you basically have no access to the capital markets as a government, as a treasury, and you have this budget that's almost entirely consumed by servicing your debt. I mean, my dire prediction is you're going to be in the 2030s with no welfare system, potentially 50% unemployment rates or higher, no Social Security or limited Social Security, a bankrupt Social Security system, a bankrupt Medicare system, and that's just the U.S. This is going to be around the world. This is not unique to us. But basically, the unwinding of a Ponzi scheme that started after the Great Depression or during the Great Depression, and has ramped up each cycle and has really been, ramped up crazily in this last cycle. So I just don't. I think it's the end of a super cycle, and I define super cycle as that big cycle between two depressions, the 1930s and the 2030s.
That's really interesting. It's because your end game is incredibly aligned with so many of the guests that I have on this show. The difference would be your expectation that we can continue to kick this can down the road a lot further than people think. I mean, to add in another 20 trillion to the balance sheet, to be still having the stimulus conversation in 2030 is beyond. I mean, it's not that far away though. When it's 7 years, right? But
right.
Like just relative to a lot of, granted, gold bug leaning guests I have on this show, which tend to trend towards pessimistic dystopians specific to Fed policy. You're almost more optimistic in the near term, right? That we can play this game.
What I say, I say the difference between a Peter Schiff and I is Peter Schiff thinks we're down for the count this time. Right. I go, as long as you have deflation, you have a printing press. Yeah. That game ends when you have inflation because the printing press is shut down. So it buys you one more cycle. What I also do tell people, because they think I'm endorsing, I go, this is not at all an endorsement of anything. I'm just telling you this is inevitable. This is where we're headed. It ends up in something worse. People can't figure out. They go, why are you rooting for a meltdown? I'm not. I'm telling you what's going to happen. I'm just forecasting. I'm not endorsing.
Now, that's an important distinction because you can forecast the price of something and not have any emotional attachment to the asset, which for some reason triggers people. It's like, I own gold. I'm not a gold bug. If you love, love the asset all you want, guarantee that asset does not love you back. It's a one-way relationship.
Yep. And every asset has its day in the sun and has its dog day,
Yeah. I love that. Look, David, I want to thank you for coming on and chatting with me. I feel like we got to do a follow-up towards the end of this year and revisit a lot of the conversation points. I want to point everybody to your Twitter, David H. Contrarian. It's at David H. Contrarian. And you produce a quarterly macro report. To get access to it, they just DM you on Twitter. Is that the best method?
Yeah, that's probably best. I'm on Twitter every day, but just to correct it, it's at Dave H. Contrarian, not David. So
thank you.
It's an easy mistake. And by the way, there are lots of people out there. I've got 190,000 followers, so I'm one of the typical with a number of followers that gets the fake accounts. So people have to be buyer aware that there are lots of people out there that have a handle. They'll have my profile picture. They'll have everything that looks like it's me, and they'll change one letter in Contrarian or something, and you'll be thinking you're following me, and you're not. And it's some a-hole that is just out there to create a nuisance.
You mean that wasn't you selling me crypto trading tips the other day?
Right. Yeah, exactly. Yeah, I get a lot. A lot of them will put out a sarcastic tweet. They think I'm nuts anyway, so they'll put out something that sounds like me but in reverse, etc., or more exaggerated. So
Dave H. Contrarian, there it is, and DM him for the quarterly macro report. Check that out for sure. Once again, thanks for your time, Dave. I appreciate it.
Okay, Jay, great to see you.
Thank you for tuning in. I hope you enjoyed this conversation. Now, if you want to take the next step, I publish a weekly newsletter and it's free. There's a link to subscribe right beneath this video, and you can join me and 50,000 other investors weekly for this exclusive content where I share my key action items and takeaways from conversations just like this and plenty others. Thanks for stopping by.